So I think anything we can do to educate the public, if you can convince people, if they understand the volatility of the stock market, I'm not saying anybody should buy a stock. I'm just saying if you purchase a stock, you ought to do certain things. If you purchase a stock and do certain things, you will do better. If you're not ready to do those things, you should keep your money in the bank. Keep your money in a money market fund. Some people aren't willing to do the homework. They don't have the stomach for it. They should stay out. They're not doing anybody any good by taking half their life savings and putting in the stock market. Or they've been lucky enough to save $50,000 or $60,000 to send their kids to college, and one's going to start in a year, and they're going to take all that money and put it in an equity mutual fund with a one-year horizon. That's doing no one any good. So I think the more, whether it's the banks that explain it, the brokers that explain it, anybody that does, and we're working on this at the SEC is working very hard on this to explain to people the nature of these products. If they understand them, they'll do better with it. More information, the merrier. Fidelity's launching a major study, will be out the end of this year, on retirement. We've interviewed over 1,600 people, over 300 experts. We're going to put a major study on, trying to explain to people about nature of retirement and how they can best understand how they should invest their assets. We're not going to mention Fidelity at all, of course. It may be subliminal in it, but we're trying to help. And the more we can do this, and there's been an incredible push by the SEC to do this, and I think it's a very positive element.
What do you think of the SEC's proposal to require mutual funds to adopt a quantitative rating scale for riskiness, number one? And what effect do you feel that the new shareholder rights proposals for more open disclosure and communication are having on companies and the markets?
On the second one, I'm not too familiar with the first one. On the second one, I think you have to be careful in crossing the bridge on how much we get involved in managing companies. I think there should be disclosure of what people are getting paid. There should be disclosure of how many shares they own. But I don't think we should be deciding whether they should make this acquisition or whether they should expand this plant. When you get too involved in running a company, it's very complex, and a lot of great companies have made a lot of decisions you haven't heard about because they decided not to do something. Some of the best decisions they didn't do was to not do something. And if they're under all this pressure from shareholders of what to do and what not to do, they're going to take their eye off the ball, and they're not going to be able to run the business. And companies are doing well because the companies do well look out 5, 6, 7 years, and some of the decisions they make may not be the right thing for the next year. The more and more we concentrate on what they're doing and we keep commenting on as outsiders, it's going to be run by an enormous committee, and we'll get committee results. So I don't think that's going to help anybody. But disclosure of relevant facts, of how many options people have, or the options at the market, what they're being paid, I think that's important, how many shares they own, what the company's doing. I think they used to not have a letter. I mean, it's not that recently that you have comments by the chief executive at the stop and hand report. They never used to have to make that. There's a letter saying what happened. I mean, it really is a very valuable piece of information. You don't realize this company spent a lot of time on this.